What's up, everybody? Welcome back to Coin Crusader. Today I want to start with something a little blunt, but I think it needs to be said. 99% of people in crypto have no real idea what they're talking about. In this video, I want to break down exactly what that means and give you a simple way to figure out whether you're one of those people. And stick with me because by the end of this video, I also want to talk about what I believe could be the thing that finally marks the bottom of this cryptocurrency market. There is one specific trade quietly unwinding right now that I think is going to have ripple effects across the entire DeFi sector. No pun intended. I want to paint that picture for you and show you what I believe has the potential to be the black swan event of this 2026 crypto cycle. There is a lot to unpack here and a lot of important concepts that I think people are completely glossing over right now. Before we get into it, if you're enjoying these breakdowns, do me a favor and hit that like button and subscribe to the channel. It genuinely helps the channel grow and helps more people see this kind of analysis. Okay, let's jump right in. Over the past couple of days, I've done a bunch of podcasts, talked to a ton of people in this space, and really just tried to take the pulse of the market to see where everyone's head is at. And honestly, almost every single time I talk to someone in this industry, outside of a few specific circles, the conversation always drifts back to one core thing: the price action of the underlying token. That's it. That's the whole conversation for most people. Here's what I mean by that. When people talk about Solana, when people talk about Ethereum, and especially when people talk about something like Hyperliquid, the entire conversation revolves around the price of the token. The sentiment, the excitement, the fear, all of it hinges on what the chart is doing that week. And look, I get it. There's a real emotional component to that. But for most people, it's purely a trading vehicle. It's just a way to speculate on short-term direction. And while that's absolutely a valid way to make money in the near term, it completely ignores what actually drives success over the long run. Think about it this way. If you took a snapshot of what was successful in the year 2000, right in the middle of the dot-com bubble, that snapshot would tell you almost nothing about what would actually be thriving 10 years later. What would have told you something useful was a deep understanding of each individual business model and which ones had a real shot at surviving. Because at the end of the day, only one thing really mattered: where the big institutional money was eventually going to flow. Financial institutions were always going to deploy serious capital into the products, protocols, and companies that had a genuine long-term vision and were building something sustainable, something that could actually stand the test of time. And the reason institutions gravitate toward those kinds of assets is simply how humans invest in general. People look at a company, a stock, an asset, and ask themselves one core question: how relevant is this going to remain in human society over time? The more relevant, the more influential, the more essential that asset becomes, the more investment capital it naturally attracts. Now, sure, it can get more nuanced than that in practice, but try to find a real counterexample. Whether it's Tesla, whether it's Nvidia, whether it's Walmart, the companies that built long-term sustainable value and stayed relevant in society are the ones that ended up performing the best over time. And notice something important here. None of that has to do with the short-term price action of the asset, especially in its early days. It has everything to do with whether that asset is building something durable, something with a real long-term value proposition. Here's my honest take. The vast majority of cryptocurrency projects out there focused on things that were, frankly, unsustainable. We have a global financial system that's over 200 years old, and most of the financial products that crypto tried to reinvent already exist in some form. So many crypto projects tried to throw out everything that came before them. They essentially said, forget the old system entirely, let's build something brand new from scratch. And look, I respect the ambition, I respect the vision behind that, but in my opinion, it was never realistic. Cryptocurrency technology, at its core, is not the brand new financial system a lot of people imagine it to be. It's new rails underneath an ever-evolving financial system that already exists. That's the part I think most people completely missed. Think back to the last real revolution in finance, which I'd argue was the rise of digital messaging, not digital settlement, digital messaging. I'm talking about the ability to log into your Charles Schwab account or your Robinhood account and move money around with a few taps. You're not actually moving physical money, you're moving the idea of money through a new interface, while the underlying system everyone was already using stays exactly the same. That's the pattern. And the truth is, most crypto projects out there are trying to solve a problem so much bigger than themselves. They're trying to build an entirely new financial system and leave the old one behind completely, instead of working with what already exists. And this is exactly what Ripple has been saying from day one. That approach was never realistic. While everyone else was racing to build a brand new system, Ripple was focused on something completely different. And Ripple's own team, including executives like Ashish Birla, has backed this up publicly. What Ripple actually spent years doing was securing licenses, expanding their global reach, and quietly building relationships and pilot programs with financial institutions that frankly weren't even ready for blockchain adoption yet. For the longest time, people criticized this approach. They said Ripple was wasting time on things that didn't matter, chasing pilots that would never go anywhere real. But what Ripple was actually doing was building trust and learning exactly what their future clients would need once they finally were ready to adopt blockchain technology. That's the piece I think so many people in this space missed entirely. A lot of people assumed the old financial guard would either never adopt blockchain technology at all, or that they'd be completely disrupted and replaced by new players coming in from outside. But Ripple's bet was different. Their bet was that, just like every other wave of new financial technology before it, this one would be iterated on by the existing system rather than used to replace it entirely. Ripple's actual goal has always been to weave new blockchain-based financial layers directly into the existing financial system, rather than trying to overthrow it and rebuild everything from scratch. Because they understood early on that the second path was never going to happen. I genuinely believe we're heading into an era defined by institutional adoption, and the players who took the realistic path, building rails and products that the old guard could actually plug into, are going to end up being the NVIDIAs, the Teslas, the Walmarts of this next generation of assets. And I think XRP is going to be sitting right at the center of that shift. As institutional adoption accelerates, people are going to want a way to invest directly in the crypto projects fueling the next generation of the financial system. And in my opinion, the player that has taken the most realistic, grounded approach to making that happen is the one quietly weaving the XRP ledger into the actual infrastructure of the old guard. Not telling banks and institutions to drop everything and go hire a team of blockchain engineers, but instead injecting crypto rails directly into their existing operations through real partnerships and real software they actually need. Now, with all of that said, I do think there's one more hurdle this market needs to clear before we can really move forward. And I touched on this earlier in the video. A lot of you have been asking me what's actually going to mark the bottom of this market, what's going to finally stop the bleeding. And here's something I've noticed after going through multiple market cycles. It almost always comes down to someone going belly up. Someone gets caught badly offside. Someone gets exposed doing something they shouldn't have been doing. And that's usually the real reason behind a wave of heavy selling. People keep asking, what's actually wrong right now? Sentiment seems fine. Fundamentals look strong. Institutions are coming in. So why is the market still selling off? Honestly, I'd bet there's someone out there right now on the verge of going under. Someone on the edge of a serious blow-up. My guess is that this player has probably been quietly selling crypto for the past couple of months. And there are likely people on the inside who already know this entity is in trouble and have been trying to front-run the eventual fallout. Could this be connected to that brutal October crash? The one where prices fell something like 90% in minutes before snapping right back up? There were definitely some strange things happening around that event that never got a clean explanation. I don't know exactly what the full story is, but here's my honest guess. I think a meaningful chunk of the DeFi market, the part that's been under real stress lately, has been parking a lot of its reserves and capital into products like STRC, which is Strategy's preferred equity offering. If you actually look at a lot of the yields being advertised across DeFi platforms right now, they line up suspiciously close to just under what Strategy is paying out on STRC. My honest theory is that a significant portion of DeFi protocols out there are essentially taking out loans against user funds, funneling that capital into STRC, pocketing a small spread for themselves, maybe around 2%, and then turning around and paying users anywhere from 8 to 10% in yield. In my opinion, that setup has some uncomfortable echoes of the Terra Luna collapse. And if I'm right, it could have serious downstream consequences for the entire DeFi market. What we're seeing right now with STRC trading below its intended value could be exactly the reason behind a lot of this recent crypto selling, as people scramble to cover collateral and shore up their positions. Now, I want to be completely transparent here. I don't have hard proof that this is exactly what's happening. This is my own read on the situation based on what I'm seeing across the market. But a lot of you keep asking me what the biggest red flag is right now, and honestly, this is it for me. I think we're looking at the downstream effects of people getting a little too greedy, treating STRC yields like free money, plugging that strategy into the back end of various yield-generating protocols, only to eventually discover it was never actually free money to begin with. We'll see how this plays out, but my gut tells me there's something brewing beneath the surface that we haven't fully uncovered yet, and we haven't seen the real blow-up happen just yet. That said, this is usually how these downturns finally resolve themselves. Someone eventually floats to the surface, and honestly, I wouldn't be surprised at all if this ends up being right at the root of it. That's going to do it for today's video, Coin Crusader fam. Thank you so much for watching all the way through. I really hope this update gave you a clearer picture of where things stand. Until next time, pickle out.